Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And Nation, by far the top fear investors shared in our survey last week was losing their hard-earned money. For 2 out of 3 investors, it was the fear of that loss that kept them from investing more or sooner. Now with stocks hitting all-time highs and threats lining up, that fear could become a reality, and the test is going to be over the next 28 days. Now, I'm not talking about a full-on stock market crash, but even a 5% correction is going to feel much worse in the highest flying growth stocks. I'll show you exactly what's coming, 4 ways to protect your gains, along with updates to shares of Alphabet, and a must-see warning for anyone investing on Robinhood. But first, I want to share an investment I just made in Gigastar and your opportunity to tap into growth in the creator economy. All you out there in the Bowtie Nation will remember, I used Gigastar to sell an investment in the YouTube revenue of this channel, with investors getting 36% of all future revenue. So far, over 2 investment rounds, the 1,300 investors in the channel have collected almost $44,000 in distributions on their investments. And now Gigastar is opening up an investment round in the platform itself. The company has already raised $9.8 million from venture capital, that part of the market where I used to work, investing in fast-growing companies before they go public. But now that opportunity is opening to all investors. I'm going to link to the WeFunder page in the description. There you're going to see all the financials and how the company is ready to launch the first ever secondary market for creator tokens. Revenue processed by the platform jumped 364% over the last year. Gigastar revenue is expected to reach $1.3 million this year. And this could be an entire video in itself, talking through that investment and the upside. In fact, Brian Kim over at Clear Value Tax did a video on why he invested, and I'm going to link to that in the description as well. For myself, I spent nearly a decade in venture capital analyzing just these kinds of deals, so for me it was a no-brainer investing in Gigastar. I want to get back to this week's stock market update, but look for that link to the WeFunder page in the description and check that out because this funding round is already oversubscribed and closing soon. Back to our main topic though, and folks, whenever I see headlines like this, like 200% pharma tariffs are coming and Wall Street just shrugs it off at the same time that stock market valuations are surpassing the mania that we saw during that dot-com boom, I start to get a little edgy. Maybe part of that is I just started investing in 1999 at the height of that bubble, only to lose nearly all my money over the next 2 years, so maybe a little gun shy there. The $100 or so I was able to invest on a corporal's pay in the Marines doesn't seem like much right now, but it was everything back then. Of course, the story now is that AI is bringing a new era of productivity that's going to cause a boom in profits. That tech and AI companies creating that era are benefiting now, but the good times are going to roll into stocks soon, and pushing the S&P 500 up another record close last week, its 10th record close this year. Now, against the threat of tariffs and inflation, the market reasons that Trump has always backed down when it started to weigh on stocks, and this time is going to be no different. But Nation, with 20 years investing and more than 10 years as a professional analyst, I got a question: is the market missing the trees for the forest here, focusing on those big storylines, but missing out on the individual data points that matter and that could be pointing to a summer correction? First, while investors are asking will he, won't he on the tariff deals, tariffs are already hitting corporate profits and will likely get worse. The Treasury reports it's collected over $100 billion in tariffs already this year and could top $300 billion for 2025. That would be an increase of more than $228 billion from last year's duties. And now before we all shout a big yay us, that $200+ billion is being paid by someone, right now by US companies. Consumer prices jumped 2.7% from the year to last month from a 2.4% pace earlier, showing companies are passing some of those costs on to consumers, but this is a no-win situation for investors. Either companies pass on more of those costs, hitting consumers and slowing the economy, or they eat those tariffs and profits go down, hitting those stock values. And while an extra $200 billion in costs isn't going to break a $30 trillion economy, there are knock-on effects here that nobody is watching. That uncertainty around tariffs has put any large-scale business spending on hold, unless it has anything to do with AI. Core capital goods orders are down $75 billion a month, and we're just starting to see it in consumer behavior as well, with furniture and logistics companies reporting historically low demand. And so this is what we're going to start hearing from companies as they report those second quarter earnings and then give their full year outlooks over the next few weeks. Wall Street already expects companies in the S&P 500 to report just 5.6% earnings growth from last year, the lowest earnings growth since 2023, and even that modest growth hides a darker picture here. Expectations for just 2 sectors, communication services and technology, to post earnings growth of 30 and 16% are distorting that average, with 8 of the 11 stock sectors seen posting profit growth of less than 1.5% for the quarter. And it doesn't get much better from there, with expectations for companies to report 7.4% profit growth when third quarter reporting gets underway in October, But with higher costs, both tariff related and otherwise, there is no way companies are going to meet this bar on expectations on just 4.9% revenue growth. And that means over the next 4 weeks of earnings reports, companies are going to be falling all over themselves to lower those expectations, warning on their profits for the rest of the year. With stocks already trading at bubble level prices, investors aren't going to like that story. Research out of Apollo Global Management finds the PE ratio for the largest 10 stocks now more expensive than during the dot-com bubble and only slightly less expensive than in 2020 when the government was throwing $5 trillion at the pandemic. Now I'm going to share 4 ways to protect your money next, but understand folks, you should never change your investing strategy 180 degrees no matter what scenario. Stocks will rise over the long term, and I do believe in that AI productivity story, so you always want to have some money in the stock market. Also understand protecting your money at times like this isn't about market timing or trying to beat the market. It's about protecting what you've earned. We've made a lot of money this year, from 121% upside on Symbotic to a return of 233% on SoFi since we started buying, and a gain of almost $350,000 in shares of SMCI. There is nothing wrong with taking a little risk off the table and protecting yourself when those arrows start pointing down. But this has got to be a personal decision. This is what I'm doing, but you need to look at your own portfolio and decide for yourself. Investors tell me their number one fear is losing that hard-earned money. 57% of respondents in our recent survey, but then they keep chasing those bubbles as they inflate, never taking profits until it bursts, and there's nothing left. One thing you can do is just put new money into the value sectors, like healthcare, where stocks are down 3.5% so far this year, the worst performing sector. Healthcare stocks like Merck, United Health, and Medtronic are easily the least expensive group in the market, trading at just 16 times on a forward price-to-earnings basis. The only sector to trade more cheaply than its 10-year average PE ratio. You can also position more of your portfolio in relatively safer sectors, like utilities, which tend to fall less in a bear market. With electricity demand set to surge over the next several years, along with prices for utility gas jumping 14% and electricity up almost 6% over the past year, you know utility companies are going to make money. And none of these means having to sell out of your favorite tech stocks. It can be as simple as putting new money into these safer sectors, or you can use the money you make from this next strategy to create that cash to invest. The covered call strategy is one of my favorite ways to lower risk while creating cash flow on any stock. For every 100 shares you own, you sell a call option on the stock, collecting money for that option. This is the strategy I've used for both Advanced Auto Parts, ticker AAP, and Ally Invest, ALLY, selling calls at different strike prices to collect over $21,000 in cash. I lowered my risk on both stocks and still have some upside in the shares as they head higher. And I showed you last week how to set up a put spread strategy to profit from a market downturn without sacrificing the upside in your best stocks. I used the August 15th options, which include all the big downside forces like tariffs and earnings surprises. Here I bought the puts at the $610 strike price for $5.70, while selling the 600 put options for $3.94, which means my total cost is just $1.76 per share. If the market falls less than 5% to $600 on the S&P 500 ETF, I will make 468% on this strategy, covering any short-term pain in my stocks. If you haven't started using options yet and all this is just a little confusing, take advantage of the exclusive community discount on our Ultimate Options course. Save $150 off and get everything you need to protect your money with options by using the coupon code in the description below. On to the stocks I'm watching this week. Huge week for earnings here. Capital One Financial, ticker COF, reports earnings on Tuesday with expectations for an outsized 33% jump in revenue, a pace of growth expected to continue after its completed $35 billion acquisition of Discover Financial Services. Now, this stock is no longer cheap here, trading at 2.1 times on a price-to-book ratio, about twice as expensive as it's traded at in the past, and fairly pricey for a bank stock, but it could still be a good buy valued like a credit card company. That addition of the Discover Card network opens up new revenue here, potentially moving Discover Card members into banking and business with COF. And it's also cheap when looked at as a card company, with a P/E ratio around 14 times versus almost 20x valuation for American Express and 28 times for Visa. Shares have had a strong run, and I might wait for a post-earnings dip, but this is definitely one to watch. The CME Group, ticker CME, reports earnings Wednesday, followed by NASDAQ NDAQ Thursday, and while both are up about 17% year-to-date, we could see a surprise upside on these earnings. The CME is the global leader in derivatives trading in everything from crops to metals and energy through its futures and options. NASDAQ operates the tech-heavy stock exchange as well as providing trading data and market infrastructure. And connecting the dots here, we've seen the trading revenue at the major banks surge for the second quarter reported last week. That massive down then up in the market, the policy uncertainty, and just the geopolitical craziness has caused investors to jump in and out of positions, driving trading revenue at JP Morgan up 15%, and that narrative was the same across all the big banks that reported. Futures and other derivatives are one of the best ways to hedge positions, and while the upside is partially priced in here with revenue expected up 10% for the CME, there's a good chance that we see higher growth and an upgrade to the full-year forecast. I'm also watching Enphase Energy, ticker ENPH, reporting earnings on Tuesday after what has already been a brutal year for the stock, down 42%, really policy Armageddon for the renewable energy companies. Now, I highlighted Enphase a few weeks ago as one of the few solar companies with the cash flow and the financial health to survive this tough environment, and this is getting to be a very attractive valuation at just 3.5 times on a price to this year's expected sales valuation because, like it or not, folks, we are going to need more than just oil and gas in our energy mix. Electricity demand is surging from the AI data center buildout, with commercial power demand forecast to double in some regions and grow at 3 times the rate that we've seen over the last decade. Solar and alt energy is about the most unloved industry right now, and it won't turn around overnight, but this is one to start buying before it does. Alphabet, ticker GOG, reports its earnings on Wednesday with the stock struggling, down 2% this year on multiple rulings against monopoly practices and the threat to AI to its dominance in search. On the stock's weakness, but still solid earnings growth of 19% this year, shares have become the cheapest among the big tech, trading at just 17.5 times on a PE basis, versus valuations around 27 times price to earnings for Apple and Meta, and as high as 32 times for Microsoft and Amazon. Now, there is a lot of uncertainty here, and that's weighing on the stock, but I continue to argue that shares are a strong buy in any outcome. I worked through a sum of parts valuation last month to show the company worth well over $4 trillion just on its search, YouTube, and cloud segments. That's almost double the stock price right there. Then, of course, the lottery ticket here continues to be its Waymo division, now serving over 250,000 paid robo-taxi rides a week and dominating what could be a $1 trillion market. Nation, this is a rare value play in tech, and I'm buying long-term. Looking at the bigger picture here with the Sector Spider sector tracker, 8 of the 11 stock sectors did close higher last week, with technology and utilities really the odd couple here. You would expect tech stocks to do well in an up market, but utilities is usually a laggard in those markets as investors rush to the higher growth. Now, this does tell me 2 things, though. First, the market isn't as strong as it appears. Outside of those 2 sectors, returns were pretty middling at best. And second, it's only the enthusiasm for tech stocks that is holding up the index. With the sector accounting for 34% of the overall index weighting, if it weren't for that very strong 2% return on tech stocks last week, the overall market would have been down or flat for the period. Now, that's fine if tech companies can continue to report that 16% profit growth expected last quarter and next, but if that narrative breaks down, so will the market. Oil stocks were the big losers last week, with the sector plunging 3.5%, even as the price of crude only dropped 1.4% to $66 a barrel. Now, that's down from the Iran-related surge in June, but well off the lows for the year. But the problem here is with U.S. explorers at record production and now OPEC countries increasing as well. The IEA estimates that we're now in a global oil surplus of about 600,000 barrels a day. A slowing global economy and weak demand here in the U.S. means that market isn't able to use up all that excess production. Now, the sector is still slightly positive, with energy stocks up 1.1% for the year, but more short-term weakness should be expected as those industrial tariffs on copper and steel slow the economy further. Against all this, energy companies are still cash flow positive, so long-term investors can pick up good names like Chevron, ticker CVX, and Diamondback Energy, FANG, at discounted prices for those solid long-term returns and dividends. Updating our market outlook and that warning for Robinhood investors. There's little economic data out this week, but that doesn't matter because the market is going to have more than enough with the news of second quarter earnings, which ramps up with 112 companies in the S&P 500 this week. The big banks set a very positive tone, easily beating revenue and earnings forecast on higher trading activity last quarter, but that strength is going to be tested as those other sectors report. The market has had a very strong 3 months, with the S&P 500 up 19% and tech stocks in the Nasdaq jumping 28%. Though the momentum seems to have slowed down recently. The last 2 weeks has seen the S&P 500 up just 0.3%, while the old-school Dow index has fallen 0.9% over the period. That means stocks will continue to trade on that razor's edge as the August 1st tariff deadline approaches. Trump has already said there will be no more pauses and has threatened rates back to 30 and 40% for some countries. While the market and some countries seem to be calling his bluff again, there's going to be a time when that's tested, and investor fear is going to spike. Now, since I do believe the president is going to eventually relent to save the market, but not without a little more pain on the way, I'm using some short-term strategies for that protection while I wait to buy on the dip. Now, here, a giant warning for anyone investing in the stock tokens on Robinhood. The price you pay could be 2 or 3 times higher than the stock price. Now, understand, this isn't about just investing on the Robinhood platform. I have an account there for the free stocks. It's a good platform, but There's a very big danger in these stock tokens right now. These stock tokens are 24/7 investments based on real stocks like Apple and Amazon, set up on the blockchain so investors can trade anytime. And it seems like a great idea. Foreign investors can get access to US stocks. Investors here can buy or sell anytime outside market hours. The problem here, though, is because there just isn't much trading yet. The price of these tokens can be as high as 3 times over what the stock is trading at in the normal market hours. A Wall Street Journal report found the price of AAPLX, the Apple tracking token here, jumped to $236 on July 3rd, almost 11% more than the price of the stock closed that day. And the token for Amazon rocketed to $891 each on July 5th, almost 4 times the price of the stock on its most recent close on the previous Friday. Now again, this isn't a problem for the regular stock trading on Robinhood, just for those new tokenized stocks. I do think it clears up in the future with more people trading these, so more liquidity and those lower gaps in the price, but there are always going to be glitches in these new technologies, so just be careful out there. Don't miss your chance to invest in Gigastar with me and over 2,000 investors. Click through the link in the description. Check out their investment round on WeFunder. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.